In this segment, I'd like to discuss briefly why the economy can matter so much to stock valuation. Although it's very difficult to time stock purchases based on where we think the economy is, by using a very simple example, I would just like to highlight how important overall economic conditions can be for a particular company. If we take a company that has $100 million of revenues, of sales, in other words, and costs of $95 million, that company currently today has earnings of $5 million. So we're talking about a company with sales of $100 million, costs of 95, and that includes cost of goods sold, operating expenses, interest, taxes, everything, leading to net income or earnings of 5 million. So 195 and 5. Now let's assume that because of economic conditions and the general climate, that company's sales declined by 5%. So not very much. The company's sales declined by 5% from 100 million to 95 million. Now, assuming that company in the short term can't change its cost structure very much, and has very similar costs to when it had 100 million in revenues, which is a slight assumption because some of those costs would be related to the number of items sold. But assuming that it changes largely because of the staff and because of the interest and so forth, that the costs remain somewhat equivalent at 95, that company's earnings would now be zero. So so basically we've gone from a situation where we had 100 million in sales to 95 million in sales, but the earnings have gone from 5 million to zero. Now if that company had a top line that grew by 5%, the sales were up to 105 million and the costs remained somewhat comparable, which again is a significant assumption. Then because the cost would probably increase slightly. If we took costs of 95 million, that company's earnings would now be 10 million. So it would be 105, 95, and 10. Now this is a very stylized example, but the costs actually don't vary that much, and it does serve to illustrate one very, very important factor, which is that when the top line of a company changes, because of the costs involved leading down to the earnings line as the final entry on the income statement, that has a very significant magnified and if you like, leveraged impact on the earnings. So changes to the top line of a company can have huge impact on the bottom line over any given 1 or 2 year period, particularly before the company changes its cost structure, for example. But this is an illustrative example of why overall economic conditions, which for a lot of companies that don't have their own growth path ahead of them, companies that are affected by economic conditions, why the earnings and ultimately the value of companies can be significantly affected in the near term because of changes in economic conditions, and why earnings for companies can be very, very volatile in environments where revenues and sales change. Why